Under what circumstances do you expect to see this scenario playing out?
Well, I think two conditions need to be fulfilled. One is there's probably going to be some adjustment along the rate hike path. So from 3 in the dot plot, now where do markets expect them? Because if you get sufficiently strong rate hikes being built in, not just for 2022, but early 2023 as well, that could very easily lead yields up between 100 and 150 basis points. Some of that is arguably already done, so there's some more left. A more important component when it comes to the 10-year is really what we believe about the balance sheet. Given the previous experience, it would be easy to mistake that there would be at least a 1 to 2 year gap between the liftoff and the start of quantitative tightening. But of course, the FOMC minutes and subsequent comments from the Fed has suggested that quantitative tightening could start much earlier, maybe even as early as late this year, which means that's really going to lift term premium in the initial aspect of things. And let's not forget that we are at record gap levels between inflation expectations and where 10-year yields are. Even with the strong upswing in 10-year yields, they're not quite near the 10-year or 5-year inflation expectations, which is to say we're still undershooting in terms of the 10 years versus inflation expectations. So these are some of the considerations that we're thinking that could lift yields very easily into the 2 to 2.5% range once hawkish Fed is reinforced. The 2.5 to 3% is the tail risk of hawkish outcomes.
When it comes to the divergence between Asian central banks and what the Fed does, particularly in EM Asia, is there a greater risk of policy mistake if what you say is this kind of coercion effect potentially playing out?
Yes, I mean, the asynchronous recovery is not lost on us. I think to a large extent, Asia continues to lag DMs in terms of the recovery. This is naturally due to the vaccine lags, the lagged pandemic spillover. It is not a spontaneous hit to all economies at the same time. So that's one issue. And the longer tourism is delayed, a lot of the tourism-dependent economies also will take much longer to pick up, which means any tightening that they need to do in view of macro stability comes at a sharp trade-off with growth. The biggest risk, though, has emanated quite recently. Here's the thought. Even if the Fed is raising rates, insofar as the U.S. inflation remains very high, the real rate differential between the U.S. and EM Asia doesn't turn adverse very quickly. So that still supported the fact that we may not see the most brutal of capital outflows. However, if quantitative tightening is started, that could really have an impact on global liquidity, and we know that may have a much more adverse impact.
What happens in economies like China, where we're actually expecting more easing, if anything, going against a global tightening move? And can you find any opportunities in that space?
Well, I think in China there's enough capital account impedance such that the policy differentials or divergence does not play out necessarily in terms of a sharply lower renminbi, which is what we might have expected if the Fed is hawkish and the PBOC is dovish. Which also means there's some degree of stability, in which case it looks, from a price effect, it looks much more attractive to be at the short end of the CGBs compared to the long end of the UST. So there's some there, but of course, this is complicated by the fact that higher volatility, both in the foreign exchange markets and in the asset markets, makes it very difficult to put in a hedge position which still looks attractive. So those are what makes the outlook very tricky. Volatility will certainly be key because there's still a lot more unknowns than knowns, given that the last tightening cycle that started in late 2013, there was 46 months between the start of taper and the start of quantitative tightening. This time there may be less than 12 or 14 months.
Vishnu, of course, we do have the BOK rate decision this week. What are your expectations there and the implications for other Asian central banks, given that the Fed is now tightening?
Well, I think we're going to rearrange the deck chairs on the Titanic. So we're calling for a rate hike in January. If that doesn't pass, there'll be another to come very soon. I think the BOK has been quite open about its views that there'll be further tightening to come. So we do expect the BOK will take that Kokomo path of getting there fast and then taking it slow, hopefully. But of course, there's every risk that they may be forced to not be able to take it slow if the Fed continues to turn more hawkish going into the middle of the year.